Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. On April 18th and April 19th, Fidelity Investments Canada hosted Focus 2024, a two-day event for advisors featuring insights from Fidelity's portfolio managers and subject matter experts. For today's podcast, we're bringing you a discussion from this event featuring portfolio manager Hugo Lavallée. Hugo manages several portfolios, including Canadian Opportunities Fund, as well as co-manages Global Equity Plus Fund with Mark Schmehl and Dan Dupont. Hugo sits down with host Glen Davdison to talk about his investment style and what opportunities he's excited about these days. Hugo also digs deep into his contrarian style of investing, explains how artificial intelligence is an area of opportunity, and where around the world he's finding companies to invest in. Today's podcast was recorded on April 18th, 2024.
Hello, my name is Hugo, and I'm a contrarian investor. And hi. So let me talk for a little bit, and then we'll moderate with Glen. So I don't believe that a great business with a great story, with a great management team, trades at a great price. It's not true. It doesn't exist. In the words of the stockbroker Mark Hanna, it's not real, it's fake, it's fugazi, it's fairy dust, it hasn't landed, it's not on the elemental charts. It's not real, man, it's not real. It doesn't exist. I think the only way to truly buy a great business at a great price is to buy in the whole. Something's happening. Something's bad that is happening to the company, the industry, sometimes the whole market, and that's the opportunity it creates. And a lot of people can't do it. They're not wired the right way. It's difficult to run towards the bad sounding story. It doesn't come naturally to a lot of people. It comes to me maybe a little bit more naturally. And this is what contrarian investing is all about. So to me, there's four conditions to my favorite setup. One is great business, high return on invested capital, opportunity to continue to deploy capital at high returns. Two is good management team. They treat shareholders, minority shareholders that they've never met, the same way they would treat their best friends or their own pocketbook. They don't use the company for their personal piggy bank. That's very important. Three, like I said, it's in the whole. Something's happening. It's in the news for the wrong reasons. It's off algorithm. Something's happening, margins are down, profits are down. Sometimes they're even unprofitable. How do you value an unprofitable business? And fourth is the concept of time. Time might be the most important tool we have as stock pickers to outperform. We're in the market, we're competing against hedge fund pods. We meet them sometimes in the wild at conferences. They're down 5%, they lose half their capital. You have a stock that's down 20, you gotta, to buy more, you need it approved by a senior partner. You have to own stocks a week, 2 weeks, normally not even 30 days. That's our competition nowadays, mostly. So when you use time, and you say, well, I'm just gonna look a little further, 6 months, 12 months, 18 months, 2-3 years, you can look at a bunch of ideas very differently. So many times I buy companies where the next quarter is gonna be tough. We all know that, but the price is right. And if we give it a little bit of time, maybe we'll be positively surprised. So in two words, contrarian investing is we're looking for low expectations, right? Low expectations. Works for long-lasting marriages, also works in the stock market. I'm looking for low expectations. Now, it's hard to disappoint when you have low expectations. I'm looking for low expectations. And that's my favorite setup. And that's what I will always prioritize. But today I want to talk to you about something a little bit different. I've made a lot of changes in the portfolio over the last 3-4 weeks. Probably the most trading I've done since COVID. So I want to talk about that. I've been blessed. I've asked permission from chief legal. I was told that I'm allowed. I can't name any names, but any idea from the crowd what that might be? Things that, I would consider them out of favor. The stocks are acting better. I'm not sure people are necessarily noticing. Please, yeah. BC. Well, I'm not going to name names, but no, it's not telecom. Sorry? I have been buying commodities, and I'm going to talk about it a little bit. Simplistically, it's more of a supply thesis. It's been 10 years of less investments, policies. Us as shareholders have told the companies, don't invest in the projects. The returns have been bad. Give us the money back. So we've created a 10-year down cycle, really, in commodities. I mean, I haven't been overweight commodities since at least 2016. And now we're coming to a point where the stocks are acting better. I'm not sure people are necessarily noticing. If you look at the completion index, which is my index that I compete against ops, so TSX less than 60, ex-currency, it's starting to beat the NASDAQ. There's starting to be in some commodities an underinvestment, supply shortage. The world is unfortunately shrinking again. I'm a kid from the 90s. The world was opening up, felt like you could go anywhere. Now, unfortunately, it feels like the world's shrinking again. Right? So it makes me sad when I have my dad cap on. But when I put my work cap on, I have to deal with that reality. So if you're investing capital in new mine, where are you going to go? What discount rate are you going to use? Costs are up, right? They're up 20 to 40% to build a mine. So what commodity assumption are you going to use? And then what discount rate are you going to use, right? We have a 1% of the world's copper supply shut right now because the country turned on the mine for a tax dispute. A little bit more complicated than that, but. So the world is unfortunately shrinking again. So it makes it hard to finance projects. We haven't been asked to finance mines in a long time, and it's probably going to come at some point. On the demand side, cyclically, a lot of countries are bad. Asia's bad, Canada's bad, Europe's bad. And the US, we've been talking about for 2 years now with you that it looks like they'll be better off. They have 30-year mortgages, right? They have less debt than we do. And it looks like, we'll see, but might actually miraculously engineer a soft landing. The unemployment rate stayed so low in the United States. So they're the engine that's keeping things running, and global PMIs are just ticking up again a little bit higher. And in a lot of commodities, unfortunately, some of them, we haven't made a dent in secular demand. And then maybe cyclically, we're going to be all right. And then finally, we have governments around the world post-COVID that got addicted to fiscal policy, fiscal stimulus. Now, Dan and I met in 1998 in honors economics at McGill, so I have my own personal opinion. My personal opinion doesn't matter at my job. I'm an observer of what's happening. We saw the budget on Tuesday in Canada. We're going to an election in the United States. Probably got to be a bunch of promises. Connor Gordon's really been talking about this internally. They found fiscal stimulus during COVID. Right before, government would have their policies and the central bank would be in to smooth out the economic cycle. And during COVID, they unleashed fiscal stimulus. And it's really hard to put the genie back in the box. So we have governments around the world stimulating and stimulating and stimulating. It'd be hard to put and now you have almost a central bank trying to fight back fiscal policy. And that's also inflationary. So let me quickly talk about 3 commodities. My favorite one in the medium term is copper. On the negative side, copper, it's mostly China, huge demand from China. I don't pretend to be a Chinese economy expert. But they're a big part of the demand. The economy is not so hot right now. On the positive side, there's a lot of positives. Like I said earlier, on the supply side, the world's shrinking again. It's hard to build a new mine. It takes a long time to build a new copper mine. We haven't had a lot of those. Some of them are struggling to produce. And then we have these big demand drivers. We have decarbonization, electrification, AI, like AI data centers. They're 7 times more electricity. They consume 7 times more electricity than regular data centers. And also we have onshoring. We have onshoring in North America. We're bringing stuff back. And then the net effect of that is grid consumption in the United States and North America is starting to grow again. It's been flat for 20 years. And now demand is starting to grow again. Now you can reflect that through many things, maybe utilities or other stuff. I think you can reflect that through copper. And, we haven't talked about, if India goes through kind of they're going through elections right now. They're going to continue to want what we have, and they might go through an infrastructure, period as well. That was very powerful to copper in the past. So we'll see. I think copper is interesting. I think it hits a lot of the notes. By the way, for all the commodities, we're short housing in North America. We're short housing in Canada. We're short housing in Mexico. We're short housing in the United States. All these things need commodities. Oil, a little bit more complicated in my view. There's no shortage of it. There's a lot of spare capacity. But there's no doubt in my mind that on a relative basis, a Canadian barrel hasn't looked that good over the last 7, 8 years. Right? I've said it before when I was talking about climate leadership. There's very few freedom-loving, energy-exporting countries in the world. Very few of them. It's been tough for Canadian energy the last 7, 8 years, right? We know it's a more carbon-intensive process, 30% more carbon exposure to produce. Although for full life cycle, at the number that I understand, it's 7% more polluting, right? Because so much of the carbon pollution happens at the tailpipe when you're burning it. So it's 7% more polluting than a regular barrel. But on a relative basis, when the world's starting to shrink again, and now we're providing tidal water access to Alberta again, right, with TMX, maybe the basin can grow finally a little bit more at a time where a lot of the world is shrinking. So on a relative basis, at least, I think the story's gone better. And finally, gold. Look, I was a gold analyst, super hard commodity to predict. Why is it going up right now, right? Yields are going back up. Maybe real interest rates are going back up. Well, one thing is central banks are buying again. Right? If you want to hold assets that cannot be sanctioned by Western governments, that's one way to diversify for people, for central banks. And I think it's possible that gold is maybe seeing in the future predicting a policy error. Right? We have the Federal Reserve that wants to keep cutting rates for whatever reason. I mean, it's not like financial conditions are tight in the United States, and it's pretty amazing how the country has done on a relative basis. And maybe it's predicting a fiscal policy mistake by some governments, too much stimulus. And wouldn't that be something if we have a hard asset cycle? Like, who's ready for that? Right? There's basically unlimited capital in the markets for technology. We're being shown private tech companies, AI companies at 200, 250 times earnings. Like cost of capital is, 200, 250 times revenues, where the cost of capital is basically zero. And, we have a 10-year down cycle in other commodities. So I'm going to stick with, higher quality companies, royalty companies, but it's a big change I made in the portfolio. And finally, you might ask, well, how did you fund this? Right? Because I tend to run fully invested. The top of the funnel, the best of the best, the Intacts, the Dollaramas, the Constellation software, I'm not touching that. I'm not going to switch from Dollarama with 50% cash-on-cash return on a new box for some shiny yellow metal. I'm not going to do that. But the middle part of the fund, the stuff that you have less conviction in, maybe you met management a year ago, they promised they'd turn around, it's been another 5 quarters, they're still spinning their wheels. And I've been looking for a reason to get rid of this stuff. I didn't really want to chase tech, it's not my style, they're expensive, they're high expectations. So finally I can find something to sink my teeth into, and it's oddly liberating. I feel like the Argentinian president, afuera, and I'm getting stocks out of the way, and I'm concentrating with some commodities. So I thought I would be, I'm putting myself out there a little bit with that thought. We'll talk more with Glen about this, but it's definitely a big change I've made in the portfolio. The stocks have rallied recently, but our muscle memory internally is to sell every rally, right? And we have a whole generation of analysts that have been with us for less than 10 years. They only know to buy good businesses. Sell every commodity rally, don't pay attention to it. And I'm asking, maybe this time's different. Maybe we're going to have a problem putting the fiscal stimulus, inflation genie back in the box. And you got to watch for your companies that have debt exposure because, we're seeing the yields backing up again. So some of these consumer companies that maybe they're crossing their fingers for lower yields, they did really well in Q4. I mean, I benefited from it in Q4. They're lagging year to date. Maybe the market's sniffing something different. So Glenn, you want to join us and we'll keep at it.
And the warm California sun. Too bad they cut that off. I thought I would be coming up here, Hugo, to talk to you after listening to the Ramones play California Sun about railways and dollar stores. So I guess that's changing. So let's talk about catalyst for all this change that you just made, because you are doing what an active manager is supposed to do. You're making changes. It's bold. What happened to make you say, I've got to make some dramatic changes, which I'm sure meant a call to Andrew to say, this is what's going to be happening?
I did call Andrew. I think it's partly gut feeling, experience, noticing the change in the market. We'll see. I mean, I reserve the right to change my mind. But I thought it was meaningful enough to share with others that, seems like there's a change in the undercurrent. And, I've been standing in front of you all for 2-3 years saying that I own minimum Canadian content, and we have had no pushback. And, Dan was reminding me last week in Montreal, remember when he took over Canadian Large Cap, I think it's February of 2011, I took over Greater Canada in November 2011. We had a hard time selling those funds because people did not want U.S. exposure. I mean, we were, why would you buy a U.S. fund? Only underperforms. It was a 10-year, bear market or relative underperformance. And now today, I'm just daring to ask, what if you have maybe a hard cycle? If you think about copper, for example, I think we might have 25 or 30 investable names in the world. Quite a few of them are in Canada, so maybe things will be different. So it's almost like we have a tale of two different tales in Canada, where on one end, our economy, is not doing really well. We're trashing our dollar, our Canadian dollar. Things look tough on the ground. I mean, my personal opinion, we've been in a recession since last summer. I mean, GDP per capita in Canada is down 2% year over year. Consumption per capita is down. I mean, we're only staying afloat in aggregate because of immigration. It's like, oh, great, we're growing, but everybody feels down about it because on a per capita numbers, the numbers are bad. So there's a part, the housing part of Canada, the productivity part of Canada, it's not a good narrative. But, I think there's some parts of the country, like our friends in Alberta, that are doing way better now. And wouldn't that be something if, the world's hungry for energy? And at some point, cyclically, things will get better a little bit. And we've just been through this underinvestment cycle for 10 years. Through policy, through shareholder demands, there's been all these different reasons. And maybe that's going to tighten things up a little bit. I tend to prefer mining, because when a mining cycle goes, it's fireworks. Look at what happened with uranium, right? Post-Fukushima, 10 years of no investments. And then demand comes back a little bit and, marvelous prices. Now, uranium's a really thin commodity, but in mining, you don't get the supply response if you get the demand. And one thing I forgot to say at the podium is, we'll stick our finger into the air and try to predict. We have a young analyst named Claire, and she runs our global copper supply-demand model. In 5 years, at the end of the decade, we're staring at a 3% deficit. Now, that guess is as good as anybody's, but it gives indication of where things are going. Now, 3% deficits is 3 Cobre Panamas that we need to find and build, over the next 5 years to have a balanced market. So these are the kind of things that I'm paying attention to. It's hard to nail them cyclically, but it seems like the arrow's pointing that way, and I want to pay attention. So I think on the Canadian side, ex-currency, some of the stocks are acting really well. Part of the reason why the completion index is doing so well is it doesn't have the 6 large banks. It's like 39% commodities, that benchmark that I'm competing against. And I want to close that commodity gap to see, maybe things are changing.
Remember, if you have any questions for Hugo, send them in through the app. These are big changes for him, so I'm sure there will be a few in the audience. We should remind everybody about the differences between Canadian ops, Greater Canada, and then we should get into climate leadership. Because you talked about Canadian content, and the prospectus does outline what you have to have from a minimum perspective, I suppose. Do you want to talk, so Canadian opportunities?
So Canadian opportunities, 90% in Canada, might be 93% Canada. Greater Canada, 50% minimum in Canada, which I've been running near 50% for the longest time. I'm higher than 50% right now, probably between 50 and 60. So those are the two relevant. So I've made some changes. I want to keep that US dollar exposure versus Canadian dollar, but also, I'm noticing that other stocks are acting better. So I'm trying to balance all of that, but definitely a little bit more Canadian content.
Interesting. Question just came in about commodities. Do you own them directly, or is it through commodity-related companies?
Yeah, it's hard to own direct commodities on our world. I mean, you can a little bit, but generally I'd prefer to own the companies. If you do it right, they give you more torque. It's really important to avoid the mistakes there. So generally I tend to prefer, if I can, like royalty companies, because they don't get the inflation, but they get the benefit on the revenue side. They don't get the cost inflation, but they get the benefit on the revenue side. And I think that's served us well. So, I like to tell my analysts, they always come up with some great new small cap commodity idea. And I'm like, why don't I just own the royalty companies? Because yes, there might not give me as much torque, but I'm going to minimize future mistakes. And I got the scars on my back for that. So I tend to go heavy more in, inflation edge, royalty companies. And I think that's a good way of doing it.
Well, which segues into the second part of that question. And I know you're not a macro guy, so don't hit me in the arm, but is inflation here to stay?
It's possible. I think we're getting a little bit ahead on, we're going to go back to whatever, 2%. And, it's as much macro as I'm willing to discuss. But look what happened to CPI last week, right? So, I don't think it's breaking news anymore. But what if inflation stays a little sticky? Inflation and rates will, in a way, create the CPI inflation. What if commodities, get in the way? There's some things that are really tight, like refining is tight. It's tight in North America. And if you're being told you won't have a business in 20 years, no board's going to approve a project. And if we're not making secular dent in demand, it's going to get really tight real fast. So I think there's going to be pockets of pinch points for inflation. Something to think about. So when I was thinking about mostly Greater Canada, about the whole fund, like I said earlier, it was about, the stuff in the middle that had really rallied in Q4. I thought in October people were too negative on the economy, and because some of these consumer stocks, they're middle of the road, maybe they don't have a great balance sheet. And I was just dying for a reason to get rid of them. And now you can diminish those bets and focus more on kind of inflation hedges.
Very good. You are contrarian. If we talk about other themes outside of what you've just mentioned at the podium, how do you avoid a value trap?
Me? Mm-hmm. Yeah, Connor, I think, gave a really good, and I try to, learn from him on that, is it's okay to buy, not every contrarian idea is going to work, and that's fine. When they do work, it's like fireworks. They give you so much compounded return quickly. It really helps the whole fund. The issue is if you have a big loss. So typically, when I try to do contrarian investing, go for top quality companies. I used to do it for everything. And, top quality companies, the Dollaramas of the world, the Couche-Tard, the Five Belows, really wonderful companies that have fallen on hard times. And obviously watch the balance sheet. And Connor talked about that, and Peter Lynch used to talk about that. Know what you're cheering for, and I think I'm trying to get better at that. Simple thesis, 3-4 points. What am I cheering for? And all of a sudden you start cheering for other stuff, it's not a good sign. Might as well move on.
And do you demand that of the analysts when they come in and talk to you? Peter Lynch used to do that. It was that egg timer. Remember the 3-minute timer we'd read about? And it was like, get out of here after 3 minutes. What do you do? You're nicer than that, I'm sure.
I do sometimes a little bit my own thing. All I ask of the analysts is try to see the world a little bit through my eyes and try not to get too much in the way. I mean, that's honestly what I ask. It's because sometimes I come to them and it's a gut feeling, but doesn't jive with, we're 1 quarter in the fiscal year and I got 3 quarters to my bonus. And I'm like, dude, like everybody's doing the same thing you're doing. Try to think about things differently. So, and I think I'm successful with that. I try to work with them to, expand their minds, use their imagination, and we're quite successful at that. I think a lot of them know what I'm looking for. But mostly for me, it's about if you have a gut feeling, even if you don't feel it, don't get in the way.
Mm-hmm.
Can we please call the company? Let's set up a call. Let's revisit. And sometimes, I had a gut feeling, and tell the analyst, no, you were right. I see it. It's too messed up. It's just not for me. It's not my setup. But no, we have a really good collaboration. I rely a ton on the team,
mm-hmm.
right? It's really important for me to talk to the company. Companies have a working model, have good relationship with a lot of the other PMs. And no, it's important. People know what I'm looking for. Every now and then I get a positive surprise. My phone rings and somebody's calling me with a great idea. Oftentimes is me, pointing something out, and it's good. That's how I do it.
You're a sponge. You absorb from so many people. It's true. You have a wonderful team to work with in Toronto, but you also work with people globally. One time you connected me with Annetta Winnemco, who runs the Consumer Industries Fund, to do a presentation to the team, which showed me that you're connected to people outside of just Team Canada. How do you continue to do that? And when did you start fostering those relationships?
Well, Fidelity is a wonderful place where we can have a lot of meaningful impacts.
Mm-hmm.
But I would say, and I got that from Connor, I got a little book where I put some notes because I'm getting old, so sometimes I have to take notes and stuff to do, pick up something at the grocery store, but also stuff for work. And I put a chart in there. I have 3 circles, 5 to 6 people that I work with, a core, second ring, third ring. By the time you're at the third ring, that's 16 to 18 people. I would tell you all of those people are, based in Canada for Fidelity Canada.
Mm-hmm.
But sometimes, you can get some nuggets from other people or ex-colleagues at FMR. Mark's going to be here tomorrow. I mean, there's some things you can discuss with people outside the organization, inside the organization. But the core of what I do is truly, the analyst team and my colleagues based in Toronto.
FMR meaning Fidelity in the United States.
Right.
There was a question on Canadian banks. There it is. Any thoughts, anything you want to talk about from a bank perspective?
I think Canada is a little bit a tale of 2 countries right now. We got commodities doing better. We got the regular economy being tough. Canadian banks, they got really close on price last October. Bought a little bit, but we have prices in our head that we be more interested in some of them.
Mm-hmm.
But I think generally, and I don't mean that in a negative sense, but I think they're overowned by our clients. There's other wonderful businesses to invest in Canada. But part of the reasons why they've been lesser stocks is their return on capital has come down, so their price to books have compressed. And frankly, it's a question you should ask others like Dan, versus me, because I never covered Canadian banks. But I think I own a little bit. It's not a high conviction bet. Let's see where we land as a country economically, and then we'll revisit. But there's a price for everything.
Mm-hmm.
But you have to acknowledge that their returns have fallen the last 10, 15 years. So the price to books compress. We'll see where that takes us.
Back to the main changes that you talked about at the podium of that core of the middle sort of section of your portfolio. What's your window of opportunity? When do you make a change if you think, this isn't, I don't want to get up in front of this group again and talk about it. I think I want to make another change. What kind of amount of time do you give yourself?
It's a good question. I don't know the answer to that. I'm sticking my neck out a little bit with that thesis today.
Mm-hmm.
We'll see what that takes us. Reserve the right to change my mind. But the gut feeling was strong enough to make meaningful changes in the portfolio.
That's
talk about like real turnover, like multiple days of trading, to put the funds in the different buckets. So we'll see. I mean, I tell my wife, it seems like every trade I've made since then has been a good one. Everything I sold seems to have gone down. Everything I bought's gone up, basically. But we'll see. But, so Canadian ops has done quite well versus the benchmark the last 10 years. And one of the secret of it is to take short-term pain by not chasing commodity rallies, right? It's a concentrated benchmark. Gold rallies every now and then, energy rallies, REITs rallies, utilities rallies. And I've been, I think, quite good and successful with the team on not chasing. I rarely chase. I think it's one of my strengths, actually, and also a weakness. So I rarely chase. This time, I'm like, well, maybe it's different. And our muscle memory to sell every rally might be wrong. And, there's so much fiscal stimulus that, what's going to happen when the cycle is going to go back. And yet, we've been limiting supply. Mm-hmm. So, yeah, we'll have to see where that takes us. But, I think nowadays people just assume NASDAQ's going to outperform forever. And AI is this huge game changer, and tech to infinity and beyond. And I just dare to ask, what if we have a hard cycle? Like, who's talking about it? Who's ready for that? And we'll see. We'll see what happens. But I am bullish on Fidelity and the team. Historically, we've done quite well in those moments, the whole team generally. We might not go all in like some of our competitors, but we'll do enough to stay in the game and really push our performance past most of our competition on peers beaten basis. So I've lived through it twice, right, with the team, 05 to 08 and 11 to 14. And, maybe we'll get some sort of function of that.
Why don't we talk about climate leadership? Talk about that relative to ESG investing.
Well, I always say climate leadership, it's a climate fund. It's not an ESG fund. That's what I say. Mm-hmm. And I think we've been very consistent on the messaging. The world's need energy, and there's a bunch of solutions you can invest in there. The world is shrinking. Now, energy security is national security. And there's a lot of names you can buy under that thematic. Mm-hmm. Decarbonization thematic, energy security thematic. So I want that fund to be super successful. I think it's not misaligned at all with what I said today. I mean, I own a lot of copper names in the Climate Leadership Fund. I struggle to see how you run a climate fund without owning copper stocks, personally. We need materials, right? I mean, otherwise it's hopeless. Mm-hmm. So we need materials. So that's one thing. I think it's very consistent. We are 3 years into the fund. My understanding is we're doing a good job beating other climate funds that are offered to Canadians. I have to do a good job beating the MSCI ACWI as well under that, and I think we'll be fine. So there's a lot of, I run that fund more concentrated, more on thematic, but I don't think it's inconsistent with anything I said today. And I think you can definitely express that view through a lot of names that are consistent with climate leadership. But climate leadership, I want to be very clear, it's a trend fund, it's not an impact fund. And I put climate over anything else, right, on the kind of broad ESG spectrum. Because otherwise, how you justify mining? I think it makes so much sense from a climate perspective. Broader ESG, there's a lot of reasons why you wouldn't tolerate mining. But, I put everything to our climate decarbonization lens. That's allowed us to be very consistent with the messaging, and that's what I do in climate leadership.
Solemn talked very positively about Japan, and I have a sense that you like Japan these days. Do you want to talk about that?
Yeah, I wish Connor would have talked about it. Yeah, I kind of liked it, although, the rate of change from the companies over there hasn't been as fast as I hoped. So if we go back to thesis on Japan really quickly, lazy balance sheets, a lot of pressure for change from, the government, from the exchange. You gotta bring your price to book up. One way to bring your price to book up is put that lazy balance sheet to work. Buybacks, spin-offs. It's happening, but some of the companies I was hoping for would happen hasn't happened super fast. Mm-hmm. So some of them have been source of funds for the commodity thematic.
Agnes talked to Dan about Global Equity Plus. and you're a big fan as well, so we should talk about it. She mentioned it's $2 billion since launch. Talk about Global Equity Plus on how you complement Mark and Dan in that portfolio.
Global Equity Plus, you're buying a mountain range, right? Think about 3 individual mountains: value, growth, tech, whatever you want to describe, Mark, peering into the future. The world unfolds to him, the future opens up. And me with contrarian investing. And we've done a product where you can own all 3, because Fidelity's known since at least the 90s, maybe even the 80s, that our average client makes a lot less average return than what our mutual fund returns are. Because clients tend to come in at the wrong time or exit at the wrong time. It's not only you, it's managing your clients' emotions, right? Get me out of that fund, it's a dog. Otherwise, I'll move to another advisor. Climate leadership is all about smoothing the ride and buying a mountain range. We just run our products. I mean, there's no difference to me. But what happens behind the scene is there's rebalancing daily. So every day, basically, you own a third of each strategy. And if it gets really out of whack for a week or so, we can do a hard rebalancing. So the beauty of that fund is constant rebalancing without having to make a phone call to your clients. Imagine calling your clients in 2011, sell your Canadian products, or sell this, got to buy NASDAQ, US. It's a hard call to make. Nowadays, sell your, hypothetically, maybe you want less NASDAQ, maybe you want more Canada. I mean, it's hard to execute. So with climate leadership, with Global Equity Plus, you get a third all the time.
Can you tell us one thing you've learned from Dan, one thing you've learned from Mark? You've known them a long time.
Dan is a man of conviction, and I think I've tried to learn from that. I know Dan since...
He has a big smile on his face over there, by the way.
So I've known Dan since 1998 at McGill. I've known him the longest, and unbelievable how he can hold his convictions. And I think I've learned to do that a little bit better on the contrarian side. Mm-hmm. You know something that will work eventually. You can tolerate the volatility. Mark, mental gymnastic, unbelievable. He will tell you something on Monday with such conviction, stare you in your soul, and you will believe it, that you'll jump off a cliff for that thesis. And by Wednesday, he's changed his mind. And it sounds like a weakness, and maybe it is a human weakness, in a relationship or something. But in our business, unbelievable strength. Sometimes I get stubborn. I like to think about Mark. What would Mark do? You should get a bumper sticker. And, he changed his mind. And it's okay to change our minds sometimes, especially when the market is not confirming your thesis. And Mark's really, really good at that. So enjoy your time with him tomorrow.
Excellent. There's a question, and I don't know if you want to go down this path or not, but it's really wondering if the Fed and the Bank of Canada are going to diverge. What's that going to do to the Canadian dollar?
Yeah, well, I think we're all on the same page, basically, on the team is, unfortunately, we might have diverging policies now here, right? I mean, we're on different paths as countries. One thing that doesn't warm my heart is, if you look at real GDP per capita in Canada, my understanding has barely grown the last 7 years, and it's up a lot in the United States. So we have a productivity issue, and now we have a cyclical issue. And it's cool, we're going to build all the homes, but they're not productive assets. They're not like GDP. We need to do it, but they're not like GDP accretive per capita assets. So I think we're on diverging paths, and I think the market's sniffing that out. And that's why you're seeing such weakness in the Canadian dollar. So, we're going to try, I think Fidelity Canada as a whole is very aware of that. And is going to try to manage that volatility and that opportunity for us and your clients.
We just have a couple of minutes left. You want to sum up what you've talked to the group about today? Those are dramatic changes. You're an active manager. It makes complete sense, and that's what we pay for. Talk to everybody about just remind everybody what you talked about, but also where you fit in a portfolio, please.
Yeah, so I don't want to take away from the the contrarian narrative, right? Because that's the most important thing. Above anything else, even what I've said today, if there's something happens to a business and it's under earning, and it's a high return business that has a runway to keep investing capital with a good management team and the stock's in the hole, because people can't get past the next 3 quarters. But I think things will get better eventually, but there's not a lot of visibility. That low expectation stock, I will do that every day over anything else. Today, I just wanted to use this opportunity to ask the question, what if hard assets, commodities, bad businesses, on a relative basis start acting better? Are we ready for that? We keep being asked about banks and telcos, and it's fine. But there's other stocks that are doing well. And I grew up in Team Canada. It's been almost 22 years. When I joined in Boston, we've always been kind of Canada first. We cheer for the country. There's a lot of sad things happening right now, but on a commodity side, we have a lot of companies with existing assets that could become more important. And the world got away a little bit from Canada because it didn't feel like they needed us as much. But now that the world is unfortunately shrinking again, where do you want to get your commodities from? Where do you want to get your energy need from? Rule of law, freedom loving. The world's changing, unfortunately. And, I think there's some opportunities to look at some of our companies a little bit in a better light. So, especially for Canadian opportunities and making that change in Greater Canada, it was something that I felt important to express to clients. And we'll see. If I'm not right, hopefully they'll still invite me later in the year to these events. But I thought it was meaningful enough to discuss it.
Well, congratulations on your success. Thank you for your active management, and thank you for being here today.
Thank you, Bob.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.